This is Cost and Management Accounting, an introductory lesson series. My name is Huijun Chen. I'm from the Department of Accounting and Information Systems, College of Management at Asia University. Lesson 1, Management Accounting and Cost Concepts. Let's start from the needs of management. Both management accounting and financial accounting are required for the management, but they are different. Management accounting is concerned with providing information to managers within an organization so that they can formulate plans, control operations, and make decisions. But financial accounting is concerned with reporting financial information to external parties, such as stockholders, creditors, and regulators. Although they are different, they are both required and very important. This slide shows the purpose of cost classification. There are 5 different purposes for cost classification. Let's start from the first one, assigning cost to cost object. For this part, it's important to separate direct cost to indirect cost. Direct cost can be easily traced to the product or service itself, but indirect cost cannot be easily traced to product or service. The next one is accounting for cost in manufacturing companies. For this part, we are required to separate manufacturing cost to non-manufacturing cost. Manufacturing costs include direct materials, direct labor, and manufacturing overhead, or what we call the MOH. Non-manufacturing costs include selling costs and administrative costs. The next one is preparing financial statement. For this part, we have to separate product from period cost. Product are those costs that were accumulated in inventories, but period costs are the costs that were expensed at the period. For predicting cost behavior in response to changes in activity. In this part, we have to separate variable costs from fixed costs. Variable costs are proportional to activities, but fixed costs are constant in total. The last one is making decisions. For making decisions, management will only consider relevant costs. These are the costs that will differ between alternatives. For irrelevant costs, they should be ignored. Okay, as we understand the basic concept of cost, we can start our learning objective number 1. For this part, we need to understand the cost classifications used for assigning costs to cost objects. In this part, we will mainly focus on direct cost and indirect cost. Direct costs are costs that can be easily and conveniently traced to a unit or product or other cost objects. The examples include direct material, or what we call DM, and direct labor, or what we call DL. Indirect costs are costs that cannot be easily and conveniently traced to a unit or product or other cost object. Manufacturing overhead, or what we call MOH, is the example. MOH is the sum of all the indirect costs which are incurred while manufacturing a product. Now we can take some time to think and write. Can you name some direct and indirect costs within the manufacturing and service industries? Now let's talk about direct cost. Direct costs include direct materials, direct labor, and manufacturing supplies. Direct materials are raw materials that are used to create the product, such as steel used to manufacture cars, cotton used in textile production, and wood used in furniture manufacturing. Direct labor are the wages of workers who are directly involved in manufacturing the product. For example, the workers assembling electronics and machine operators in a car production line. Manufacturing supplies are items directly consumed in the production process. They include paint used in automobile manufacturing and lubricants used for machinery involved in the production. Indirect costs include indirect materials, indirect labor, and manufacturing overheads. Indirect materials are supplies used in the manufacturing process but not directly in the product, such as cleaning supplies for factory machines, small tools like screws or nails used in various stages of production. Indirect labor are wages for employees not directly working on the product but supporting the manufacturing process, such as factory supervisors and maintenance workers for factory equipment. Manufacturing overheads are costs associated with running the production facility. They include utility costs like electricity and water for the factory, depreciation of machinery and equipment, property taxes on the manufacturing facility, and rent for factory space. For learning objective number 2, we will identify and give examples of each of the 3 basic manufacturing cost categories. The 3 categories include direct materials, direct labor, and manufacturing overhead. Direct materials are raw materials that become an integral part of the product and that can be easily and conveniently traced to the product itself. Let's take this car as an example. The wheels and the battery are the raw materials for manufacturing this car. Direct labor costs, or what we call the touch labor costs, they are those labor costs that can be easily traced to individual units or products. For example, wages paid to automobile assembly workers, as we can see those people in the photo. Manufacturing overhead. Manufacturing overhead includes all manufacturing costs except direct material and direct labor. These costs cannot be readily traced to finished products. They include indirect materials that cannot be easily or conveniently traced to specific units or product, and indirect labor costs that cannot be easily and conveniently traced to the specific units of product either, such as rent and taxes, salary of cost controller, and depreciation of machinery. For the examples of manufacturing overheads, only those indirect costs associated with operating the factory are included in manufacturing overhead. Examples of manufacturing overhead include depreciation of manufacturing equipment, utility costs, property taxes, and insurance premiums incurred to operate a manufacturing facility. Now let's talk about the prime cost and the converging cost. Direct material and direct labor together, they are called the prime cost because they are the prime themes to manufacture a product. And for direct labor and manufacturing overhead together, they are called converging costs because they are required to convert all the direct materials into product. Non-manufacturing costs include the selling cost and administrative cost. Sometimes we call these costs as period cost. Selling costs include those costs that are necessary to secure the order and deliver the product. Selling costs can be either direct or indirect. Okay. For all executive and organizational and clerical costs, they are called administrative costs. Administrative costs can be either direct or indirect costs as well. Learning objective number 3 is to understand the cost classifications used to prepare financial statements, and they are product cost and period cost. Product cost includes all the product costs that are involved in acquiring or making a product. A product cost attached to a unit of product as it is purchased or manufactured, and they stay attached to each unit of product as long as the unit remains in inventory awaiting sale. For manufacturing companies, product costs include raw materials, work in process, and finished goods. Raw materials include any materials that go into the final product. Work in process consists of units of product that are only partially complete and will require further work before they are ready for sale to the customer. Finished goods cost consists of completed units of product that has not yet been sold to customers. Here we will talk about transfer of product cost. When direct materials are used in production, their costs are transferred from raw materials to work in process. Direct labor and manufacturing overhead costs are added to work in process to convert direct materials into finished goods. Once units of product are completed, their costs are transferred from work in process to finished goods. When the manufacturer sells its finished goods to customers, the costs are transferred from finished goods to cost of goods sold. And cost of goods sold are accounts within the income statement. Here are the cost flows and classifications for preparing financial statement. These are costs, this is balance sheet, and this is income statement. We have two different kinds of costs. One is product cost and the other one is period cost. Product costs include raw materials purchases, direct labor, and manufacturing overhead. Together, they are accumulated in inventory under balance sheet. Once the finished goods are sold, the cost for the finished goods sold will be transferred to cost of goods sold under income statement. In order to sell this product, period cost will incur. The period cost includes selling and administrative cost. Those costs are expensed at the period they incurred. Here comes our concept check number 1. Which of the following costs would be considered a period rather than a product cost in a manufacturing company? You have a few seconds to think about the answer. The answer is B and E. Property taxes on corporate headquarters and the sales commissions are period costs. Now let's move on to learning objective number 4. For this part, we need to understand the cost classifications used to predict cost behavior. They are variable cost and fixed cost. Cost behavior refers to how a cost will react to changes in the level of activity. Variable cost and fixed cost. Fixed cost is a cost that remains constant in total regardless of changes in the level of activity. But a variable cost is a cost that varies in total in direct proportion to changes in the level of activity. For fixed cost, If expressed on a per unit basis, the average fixed cost per unit varies inversely with changes in activity, but a variable cost per unit remains constant. A cost driver is a measure of what causes the incurrence of a variable cost, such as machine hours, labor hours, miles driven, and units produced. Types of fixed costs include committed and discretionary costs. Committed costs are long-term, cannot be significantly reduced in the short run, such as investment in facilities and equipment, or salaries of top management. Discretionary costs may be changed in the short term by current management decisions, such as advertising, public relations, internships for students. Fixed costs remain unchanged only within the relevant range, but the relevant range of activity pertains to fixed costs as well as variable costs. For example, assume office space is available at a rental rate of 30,000 per year in increments of 1,000 square feet. Fixed costs will increase in a step fashion at the rate of $30,000 for each additional 1,000 square feet. This is the graphic demonstration for relevant range. The relevant range of activity for fixed cost is the range of activity over which the graph of the cost is flat like this line. Okay, here comes our concept check number 2. Which of the following costs would be variable with respect to the number of ice cream cones sold at Baskin and Robbins? There may be more than one correct answer. What do you think? Here is the answer. Number C and number D are correct. The cost of ice cream and the cost of napkins for each customer. Here is a cost classification assignment. Do you still remember variable or fixed cost, manufacturing cost, and non-manufacturing cost, product cost, and period cost? And this is the answer for the cost classification assignment. Now let's move to learning objective number 5. For this part, we need to understand the cost classifications used in making decisions, and they are relevant cost and irrelevant cost. Decisions involve choosing between alternatives. The goal of making decisions is to identify those costs that are either relevant or irrelevant to the decision itself. To make decisions, it is essential to understand the concept of differential cost and revenues, opportunity cost, and sunk cost. Differential costs or incremental costs are the difference in cost between any two alternatives. Please remember a difference in revenue between two alternatives is called differential revenue. Both are always relevant to decisions. The differential cost can be either fixed or variable. Opportunity cost is the potential benefit that is given up when one alternative is selected over another. These costs are not usually found in accounting records but must be explicitly considered in every decision. For example, you can think, what is the opportunity cost you incurred by attending a class such as city class? Sunk costs. Some costs have already been incurred and cannot be changed now or in the future. These irrelevant costs should be ignored when making decisions. Let's do some concept checking. Okay, suppose you are trying to decide whether to drive or take the train to Taipei to attend the concert. You have ample cash to do either, but you don't want to waste the money needlessly. Is the cost of the train ticket relevant in this decision? In other words, should the cost of the train tickets affect the decision of whether you drive or take the train to Taipei? What do you think? Yes, the cost of the train tickets is relevant. Well, same situation. Is the annual cost of licensing your car relevant in this decision? What do you think? No, the licensing cost is not relevant. Suppose that your car could be sold now for $5,000. Is this a sunk cost? What do you think? No, it's not a sunk cost because it hasn't been incurred yet. Now let's move on to the learning objective number 6, and that is the last one. For preparing the income statements for a merchandising company using the traditional and contribution formats. This slide shows the traditional and contribution format income statement. This slide is traditional format and this slide is contribution format. Under traditional format, you start from sales minus cost of goods sold and you will get gross margin, and then minus selling and administrative expenses such as these are period costs, and you will get net operating income. But for contribution format, you still start from sales, but you subtract variable expenses first. Then you get contribution margin, and then you minus fixed expenses. You also get net operating income. So for contribution format, you will get contribution margin, but for traditional format, you will get gross margin. And traditional format income statement is used primarily for external reporting, but contribution format income statement is used by management. They are for internal use. The contribution income statement format is used as an internal planning and decision-making tool. This approach is used for cost of volume, profit analysis, segmented reporting of profit data, budgeting, and special decisions such as pricing and make or buy analysis. We will talk about this at later lessons. This is the end of lesson 1. See you at lesson 2.